A massive silver trader just got locked out of their position at the absolute worst time possible. And the official story? Just market volatility, move along. I wasn't planning to cover this, but after digging into what's actually happening, I realized the headlines are feeding you half the truth. You deserve the complete picture. So here we are. It's February 6th in New York, and before we dive in, drop a comment with the date you're watching this. I love tracking how these videos spread. What's unfolding in silver right now isn't some minor market blip. We're talking about a Shanghai trader who allegedly built a short position so massive it exceeded the entire reported warehouse inventory at the exchange. The response? Regulators hit the freeze button. Account locked. Position stuck. And the timing, combined with everything else shaking in the markets, should definitely raise some questions. I'm going to walk you through three critical pieces. What this Shanghai freeze actually means in simple terms, why the volatility explanation doesn't tell the whole story, and what I'm monitoring next, because in situations like this, the next move matters far more than what just happened. Let's zoom out for context. We just went through a brutal market stretch where everything seemed to be falling simultaneously. People are throwing around phrases like worst day since the 1980s and talking about a potentially historic recession. Right in the middle of that chaos, this silver story emerges, almost too perfectly timed, like it's designed to pull attention in a specific direction. This matters because silver isn't just another tradable asset. It's a strange hybrid, a fear trade when panic hits, and an industrial commodity when economies are building. Solar panels, electronics, medical equipment, they all need silver. When you combine monetary metal with industrial demand, you get something that doesn't behave predictably. It's volatile by nature. Here's what we know about the core event. A single trader on Shanghai futures built a short position that wasn't just large. It was the kind of size that makes you wonder how it was even allowed. The reporting uses different name spellings, but it's being presented as one person, one enormous position, one major problem. And this wasn't treated like a normal trade. The account got frozen. The trader reportedly can't touch this position for about a month. Think about what that means. When you're short, you're betting on prices falling. If prices rise instead, you lose money. If you're short and locked in place, you can't even manage those losses. You're strapped into a roller coaster with no way to get off. The simple narrative is that this trader was trying to manipulate prices downward. Maybe. But there are other possibilities. Hedging strategies, arbitrage plays, spread trades, or just a catastrophic miscalculation. We don't know which. I'm just saying when a story sounds too clean, leave room for alternative explanations. What we do have, the label naked short, meaning the position wasn't clearly backed by actual metal. We have the response, a freeze and very public attention. And we have size estimates putting the position in the hundreds of tons, while reported warehouse inventory was described as low hundreds of metric tons. That's a ratio well over 100%, pushing into territory where you start asking who approved this in the first place. The inventory was already tight, then it got tighter. This transforms from a trader story into a confidence story. When market participants doubt available supply, they stop trading price and start trading fear of being last in line. Then things got more interesting. A significant chunk of remaining silver, roughly a fifth of what was left, suddenly disappeared from Shanghai vault systems. If the available metal shrinks while the short position stays the same, that position looks even more extreme. The ratio starts approaching 1 1/3 of available inventory, not just barely over. Here's the crucial part. This position wasn't frozen quietly. Details went public through anonymous sources close to the exchange. Could be a genuine leak. Could be a controlled release. Could be internal politics. We don't know. But the effect is identical. Everyone now knows there's a massive trapped short position. And when the market knows where a trapped trader is, the market often smells opportunity. People use the phrase maximum pain, the idea that if enough participants believe a short is trapped, they might push prices higher to force covering. That's the essence of a short squeeze. But before anyone gets too excited, remember that silver is also one of the easiest markets to whip around with leverage. There are two worlds here, paper and physical. In the paper world, you're not buying actual bars, You're buying contracts, exposure. You put up a small fraction of total value and control much more metal than you paid for. That's leverage. Leverage is great until it becomes a trap. When volatility spikes, exchanges raise margin requirements. They demand more collateral. If you can't post it, you're forced to sell, even if you believe your trade is correct. This isn't theoretical, it's mechanical. And we're seeing reports of multiple margin increases in quick succession, effective immediately. Silver's margin jumped significantly more than gold's, signaling they're trying to cool down the wilder asset. When you stack margin hikes on top of volatility, you shake out leveraged positions. The ones who get shaken out aren't institutions with unlimited balance sheets. It's smaller traders who thought they were investing, but were actually renting exposure on borrowed money. Are margin hikes evil? No. Markets need guardrails, but they have effects. And when you study how silver behaves around margin events, these policy moves can act like pressure valves, or, if you're cynical, like control levers. So we have the Shanghai freeze on one side and Western futures markets tightening margin on the other. Then add geopolitical tensions, alerts telling people to leave Iran. Whatever the verification status, that kind of headline drives safe haven demand. When that happens, gold and silver can rally. Now you've got competing forces, a trapped short narrative encouraging buying, margin hikes forcing selling in paper markets, and geopolitical fear motivating people to grab physical assets. And in the middle of all this, prices are bouncing wildly. Reports say we saw several dollars of rebound in a day, back above year-start levels, with double-digit percentage moves becoming routine. Here's what people miss. Volatility doesn't just scare people, it transfers contracts. It transfers patience from the impatient to the patient. The winner isn't always the smartest. Sometimes it's just whoever isn't forced to act today. Another detail, the trader allegedly made hundreds of millions during a flash crash. Currency and jurisdiction unclear. This matters because if we're talking about whether money can leave a country, currency and jurisdiction are everything. The basic situation. The trader allegedly profited on the way down and is now stuck if prices reverse upward. If the market believes the trader is trapped, it may test that position. Not because markets are moral, but because they're opportunistic. Don't just watch the price, watch the plumbing, inventory levels, margin requirements, liquidity. Those boring details are where the real story lives. When someone says, more silver was shorted than exists, immediately ask, in which market, paper or physical? In paper markets, you can stack claims on top of claims on top of claims. That's how derivatives work. The physical market is different. You can't print a silver bar. Here's the assumption people make. They hear short frozen and assume silver must rocket higher. Maybe, but not automatically. The price most people see is heavily influenced by paper flows. If margin hikes force liquidations, you can get downward price pressure even while physical supply tightens. You can have a world where physical inventory is leaving vaults while the paper price gets hammered. Confusing, but normal for this market. That vault removal keeps nagging at me. When significant metal exits vaults right after this story breaks, you have several possibilities. Normal logistics, someone taking delivery because they don't trust the paper system, or someone reducing visible inventory because visible inventory is a signal, and signals matter in a potential squeeze. The public exposure might be a message, don't try this again. Regulators love deterrence, but even if deliberate, the motivation could be about preserving market credibility, signaling to other participants, or internal power struggles. So what do we do with this? If you're trading silver with leverage, understand the rules can change mid-game. Margin requirements shift, liquidity vanishes, spreads widen. If you're on the wrong side, you don't get to argue, you just get the bill. If you're holding physical, your experience is different. Physical holders care about availability, premiums, and delivery times. In stress periods, physical markets can disconnect from paper. That's logistics meeting panic, not conspiracy. If you're just watching, this is a case study in narrative construction. The official story is usually the cleanest, not the most complete. Volatility happened. A big player got caught. Regulators stepped in. All can be true at surface level. But the why and the ripple effects are where you either gain insight or get whiplash. We're exiting a period where cheap money trained people to buy dips and ignore volatility. When leverage unwinds, it doesn't unwind politely, it snaps. Metals sit in a weird spot. They can be the hedge people run toward, but also the piggy bank they smash to cover losses elsewhere. Industrial demand trends aren't disappearing. Electrification, grid upgrades, energy infrastructure, data centers. The physical build-out is real, and silver is embedded in it. Plus, governments are thinking more openly about strategic materials. Supply chains can be weaponized. When that reality hits, stockpiling becomes serious. Fundamentals can be intact while prices are chaotic. Both can be true simultaneously. That's why risk management isn't optional. The human element. We're told the trader lives in Europe now, and it's unclear whether regulators will allow the winnings to leave China. That's fascinating because it hints this isn't just a market story. It's a jurisdiction story. A control story. Money moves freely until it doesn't. The rules are invisible until they become painfully visible. That detail matters because the outcome isn't only about price. It's about permissions.